Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning. No, that is not the song we want. There we go. Hey guys, it is Friday. We do have some consumer sentiment coming out today, but this is actually going to be probably the quietest Friday that we've had in a while. And yeah, I was just thinking about something. Oh yes, we need to fix the light here. Like, why is this other light not working? There we go. All right, do the trick. All right, so here on the daily basis for the treasuries, we are flirting with kind of like momentum mean reversion triggers here. I'm still kind of getting this like the market wants to buy it here, but we'll see where it actually ends up going. Went back over here in Zen, you can see that you know, we had a little bit of further downside yesterday, but like and then overnight, but we've kind of recovered it. And the spread is kind of doing some interesting things. So like we flattened quite a bit over here, and there's this morning there appears to be maybe a little bit of flattening that we need to keep an eye on. The S&P 500 had a dug out pretty good yesterday. That was a pretty good win. They're kind of back into this kind of range that they had here. It seems a little rich to me right now, but we got oil. Oil also doing a little bit better, but still within its range. Gold and silver. Ooh, that looks really nice in gold, doesn't it? It looks very, very nice in gold. And silver, well, I don't know. Maybe silver could start a different trend and start moving up, but it has been in the doldrums for a really long time, man. And the dollar's still just kind of chopping just above 103. Yeah, despite the Japanese yen on a pretty consistent downturn. And then Bitcoin took a little spill lower. We're still not below 40,000. That I think would be kind of a key level, but you know, so far the ETFs haven't been helping. And what I'm seeing is like there has been about $1 billion or so that has bought into the ETFs, but there's also a lot of money moved from Bitcoin into Ethereum. Like the speculative play ended up being buy Ethereum for that to do the same thing eventually, and that seems to have hurt Bitcoin a little bit. I think that's one of the major factors behind that, at least. But I think that it'll take several weeks for it to all play out. All right, so today we do have, well, we got Fed's Goolsby is going to be speaking on CNBC at the bottom of the hour. So that is probably going to be an important one. At the 10 o'clock, we have University of Michigan sentiment in U.S. existing home sales. There's also inflation expectations with that and all that sort of stuff. Looks like Daly and Barr are both speaking later in the day. Actually, Daly's speaking twice. All right, so that's what we got ahead of us. Good morning, Jiwi. Good morning, Dom, Alan, Captain Price. I continued on that Monte Carlo thing yesterday, got some pretty cool charts. You can go into Discord and look at them right now if you want, but I'll show them to you guys a little bit later and walk through the code. But let's wait until like maybe the top of the hour, closer to the S&P 500 open, you know. Make sure that we got everybody here first. Does look like people are still filtering in a little bit. Some days, you know, it's funny. I don't know what it is. Sometimes I take forever to eat and I take forever to shower and whatever the deal is. Because there was been days where I'd be starting like right now, right? Isn't that wild? So we'll wait a little bit on going too deep into code there. And so I'm going to come over here. It's because winter warms you up. Well, I tell you what, I don't know what I would do if I lived 100 years ago and we didn't have hot showers, man. Because hot showers is like what keeps me going. I've been having the post viral cough has really been getting to me. Like you gotta, part of it is that the coughing kind of irritates and inflames your throat further. And so last night I kind of, like caught a cough and wasn't able to resist it and coughed too many times. And so I had to go and take like a well, it's not just a decongestion, but one of those to kind of like make the coughing go away. And I think I'm still kind of clearing. I guess it sounds a little better than yesterday. All right, so what do we got here on Zero Hedge? A couple of interesting headlines I'm seeing here. S&P futures approach all-time high as tech melt-up goes full tilt. Markets have been unnerved by the reluctance of major central banks to cut rates quickly in response to slowing inflation. It is difficult to see today's rebound in risk assets proving sustainable until central banks give the green light for rate cuts. Yeah. I continue to come into this thing where it's like every day I'm getting very conflicting information kind of on the sentiment side, because the S&P 500 is like at all-time highs right now. It really seems like everything's going good. Like unemployment is extremely low. And yet I see all of these people. So as an example, let me show you as an example. There's this subreddit. Let's see here, reddit.com/r/layoffs. I think it is. Yeah. And the layoffs subreddit, some of these posts in the layoffs subreddit have so many comments. I mean, that's 273 upvotes and 274 comments is a little wild, don't you think? And there's been some of these, like look at this one, 600 comments. Like there is a lot of activity, relatively speaking, in this subreddit. I can't believe it. So like it seems like what's happening right now is that employment is really good, but a lot of people are getting laid off. They're finding jobs quickly, but which basically means there is a lot of turnover in the job market right now. That's what it seems like to me. I think one thing that I'm noting in particular is that big tech has just been shedding people so much. And I think the reality was that they were paying a lot of people way more than they should ever have been paid. And, it was just getting really silly over there at Google, where you had these people that were like project managers that weren't really doing that much and getting paid like $300,000 a year and stuff like that. So I don't know if big tech is ever going to come back. Like I think there are some people that had big tech jobs that it might be a really long time for them to recover the salary that they were getting at Google, right? That doesn't mean that they will not be able to find jobs. So I see a lot of people saying that the job market is really bad. If you are looking for a job and you feel like that the job market is really bad, I would go back and kind of like take a deeper look at your approach and what you're doing, because you're probably just submitting your resume into a black hole where nobody's actually looking at it, right? That's probably what's going on. because I still get people about, I mean, it's not as common. It used to be every freaking day. Oh my gosh. In 2021, it was every day. But I still get people trying to recruit me. Trying to, they need site reliability engineers. What can I say? Although I don't think I have any intention of moving anytime soon. I am really, really engaged in what we're doing at work right now. I really want to see how this all goes. There's an interesting story about, some of the performance and problems that we've had recently, and I am excited to figure them all out and fix them. Okay, how do I cause OBS to not record any audio? I have it running, but it records your annoying voice. Thank you, Lucas. So over here on OBS, you should have an audio mixer. And on the audio mixer, if you click on the little speaker icon, it will mute that channel. So if you don't want any sound in the recording at all, just mute all of them. And something that you can do, if you have the right kind of audio cards, they kind of have this stuff built in. If you don't, you can use something like Voice Meter. And what Voice Meter allows me to do is to have multiple virtual audio channels. So what happens is I have these two virtual inputs, my Voice Meter aux and my Voice Meter VAIO. The names of them don't really matter because I don't use it for, I think, what they intended to use anyways. But basically, the music, for instance, is coming out of this channel right here. So, and then the news squawk is coming into this channel. So I have both of these channels routing out to my headphones. If I turned these on, that's when it comes out my speakers. I don't know if you can tell there's a difference, but it's coming out of my speakers there. But then the stream is only listening to this channel, and that's why you guys normally cannot hear the news squawk. Tried that one now that I restart. Yeah, this Voice Meter, you have to restart your computer for it to work. Yeah, so it's like a monitor app. I could do it with my mixer, to be honest with you, but the mixer's a little cumbersome. I could have my headphones plugged directly into my tractor mixer and CryptoPop. Haven't we talked about this before? I'm just looking. So, of course, ICT stuff is snake oil, and I have a really interesting video here on my channel where I go into it. I kind of talk about some of the flaws in their logic, and I show you the empirical evidence and backtest it and show you how it performs. So go and watch that video. It shows some really interesting stuff, and it kind of suggests that there was a period where the strategy was successful, but it was mostly because the strategy was getting popular on YouTube. So a couple of people, a strategy getting a little popular kind of helps the strategy, but eventually it gets too popular and implodes. And that's what you see with ICT. Yeah. Well, so if you, iMan Trader. So I actually kind of referenced the iMan Trader video in my video, but not explicitly. But if you want to go into like all of the personal drama and all of the stuff about ICT himself and all of that stuff, then go and watch iMan's video, and it really shows you you know, it's not a place that you want to get involved in. But didn't you ask me that the other day? Because the name Crypto Pop just seems awfully familiar to me. Oh, you're kind of new to this. Hold on, let me blow my nose. Okay, so there's this guy named Inner Circle Trader, and he has a YouTube channel that's been around for a long time, probably almost as long as mine. And he teaches price action and I guess a little bit of Wyckoff kind of stuff too. But basically what he does is he takes existing technical analysis concepts and he renames them and says it's all his own completely unique philosophy about things. So he's kind of like stealing other people's content and rebranding it. And his basic message, the thing that he says that it kind of pulls people in, is he says that the market is controlled by an algorithm, quote unquote, and that he has successfully decoded this algorithm so that you know how to trade to completely take advantage of this. And he even claims that like people came to his house like federal agents or something telling him to stop this and shut up about it and etc. because it'll ruin everything. Yeah, it is snake oil. It absolutely is. But here's the thing. YouTube algorithm picks up on it for some reason. I don't know. So he has always been like a really aggressive marketer. There was one time where we had in our channel a guy, he was there for like most of the week. And he was like, oh, you should go check out ICT. You should go check out ICT. So I go check it out and like I watched one video and I was like, okay, here's all the problems with this. And he got like super upset about it and wouldn't let up either. I kind of suspect that it was ICT himself trying to promote himself. Possible. But it could be one of his followers because they do seem to be like, it's like a freaking cult over there, dude. It's crazy. Okay. And yeah, it does sound like he's ICT himself, right? Anyways, that was before it took off and everything. So the reason why this is like a topic of discussion is that after the 2020 pandemic and during the 2021 market that was just like absolutely nuts so crazy, for some reason YouTube picked up on it. His channel started doing well. Like before he had like I think he was in the tens of thousands. I think he was like 30,000 followers or something. And now he's in like the 200,000 or 300,000 viewers, or sorry, subscribers, right? And for some reason, YouTube picked up on his channel as like a name itself. So like if you go to YouTube and you search for the term ICT, like if you go to YouTube and you search for Speculator Seth, you're only going to get me, right? But if you search for ICT, there's like a whole little mini industry of YouTube channels that are making content just about ICT, right? Like the YouTube has picked up on it as like an overarching topic and it pushes it to people. So even though this guy is like literally, I mean, come on, this stuff that he's saying is like crazy, right? The YouTube algorithm continues to push it. It's so crazy. I tell you what, the social media, there's some real problems there because it has a tendency to push trash to you. The YouTube algorithm in particular has just like really gone awry over the last year. Like the content that I get on YouTube is of such low quality compared to a few years ago. Like I don't know if they changed something in the algorithm or if this is kind of part of the same algorithm degradation over time that we see in a lot of AI or something, but it's just like really, just like a really weird thing. Yeah, well, I know that you don't care about the guy, you know, but somebody else asked who are we actually talking, like, why is this even a thing to talk about? So it's basically gotten to the point where you can't go on a trader forum anywhere without this coming up and talking to people. And if you are like us, where you actually do real empirical research on the market, right? This is one of the issues with ICT, is that part of how he got big was he said, oh, like, here's this specific strategy, because people want a specific strategy, right? And the problem is this specific strategy just doesn't work. You go and backtest it, it doesn't work. But you got all of these people talking about it, and they've been talking about it a lot this week, because had a couple of guys that they were in the Top Step Trader chat room, and they were all talking about it, and he had a bunch of defenders and stuff. And apparently the guys that do the stream were kind of favorable to him as well, which I think is just like so hilarious. But they must not have actually done their research about it. I don't know. Many YouTube video algos about YouTube being broken these times, yeah. Why would the YouTube algorithm wouldn't be designed to generate views, dude? They are not in the business of truth. They need those. Well, but I really don't think that what YouTube is doing right now is leading to more views in the long run. I kind of think that it's doing something where it's like it might get increased viewership in the short term, but not over the long term. I also think that it's doing some. One of the other things that I think happened is the infection of kids' YouTube to the rest of the site. So it used to be that even if it was kids' content, you could do targeted ads for it, and so, you know, there was all these channels that were made specifically for kids, and they appealed just to kids, and kids watched the most bizarre stuff, man. Especially the really, really young ones. They will just watch the most bizarre stuff. And the algorithm will pick up on the most bizarre stuff, right? But before, it was all just within the kids' YouTube. When they came in and they basically separated everything, they said, like, okay, we're going to have like a YouTube that's just for kids, and you have to specify if your content was designed for kids. And then we can't show ads on any of that content. So these creators that were kind of doing that stuff specifically for kids had to kind of like turn it generalized. So this infection that was in the kids' YouTube is now like everywhere. And I think that that's a large part. And then the other thing that happened was Mr. Beast got popular, right? So everybody started to try and duplicate Mr. Beast's success, which is basically like the craziest clickbait that you can think of, but you actually follow through with it, right? That's Mr. Beast. And, you know, it's no longer you get like informational content on YouTube. I mean, it's there, but you have to dig deep. And I honestly don't 100% understand how you guys find my channel. Like, I find it to be a really bizarre thing. Nobody else out there is talking about empirical data. Okay, like what we're trying to do, day trading, is really hard, and even with all of the tools and information that we have, most people are going to lose money day trading. And to be honest, I wonder if like long-term consistent success, especially in futures, is really possible because of the robots. Okay, it's just so hard to compete with the robots. Doesn't mean that it's not a worthwhile venture. I think it's a very worthwhile venture, especially with what you learn. And somebody has to do it. We need people. We need more people that are informed on the markets to be in here and be involved in playing, right? But even with all that information, it's really hard to be successful. But I am the only one giving you that information. Everybody else is, oh, I tried this, it seems to work. Go and do this on the chart. The thing that drives me crazy about the ICT thing is they say, go back test it. And what they say back testing is look back on the past history of the chart and guesstimate what you think you would have done, which, guys, is not very objective or effective. You will always bend the rules, and it will give you a rosy backtest that is not realistic. You have to do that sort of a thing programmatically. I have the ability to do these things programmatically, and so I have many videos here on this channel where we talk about specific strategies that are popular in the trading world, and I show you the problems with them. I show you why people kind of think that they work and why ultimately they're not really a very good strategy. I also have a lot of videos about actual proven stylized behaviors of markets, things that people at universities and writing in peer-reviewed journals, and a lot of these people are they work for a bank or a large institution, but they're also putting out research papers. Like my favorite, Jean-Philippe Pouchot. Where's the book? Over here. Jean-Philippe Pouchot, he wrote this book, Trades, Quotes, and Prices. This is where a lot of that information comes from if you really want to go to the source, right? And he was one of the co-founders of Capital Fund Management, which is a CTA firm, essentially. So they're running kind of a momentum mean reversion trading strategy. One of the top guys in the industry, I don't know why most retail traders don't know his name, but, empirical research. This is the best performing fund writing a book and giving you all sorts of very detailed math-based, models of the market that have empirical data to back them up. And nobody else talks about it. It's just wild. It's just wild that, and the thing is I put these videos out, and they get decent viewership, but they never picked up and to the moon. I guess I'm not that interesting. It's probably something to do with me, right? But what wilds me out about it is that, even now 2 years later, there's still nobody else talking about this stuff. And they all go and they follow these guys that literally have nothing behind them. Like ICT, he's become a millionaire from the YouTube channel at this point, right? He's going for a live interview. I bet that doesn't happen, but okay. Okay, so here's the deal, CryptoPop. Let me demystify the markets for you. The market is very statistically efficient and not very informationally efficient. So let me explain what that means and why that's important to know. Okay. So what I mean is if I go and I take, all of the data that's generated at the exchange, the price, you've got a chart, the volume, even things like the order flow, the limit orders and the market orders and all of that kind of information, right? And then I go and I do a statistical analysis of it. It is extremely difficult to find any kind of statistical aberration within that data that would provide a profitable trade. There are some, but it's extremely, extremely difficult to find them. That's what I mean by it is statistically efficient. Okay, but informationally efficient it is not. What informationally efficiency is okay, I know something about the market. There's going to be some change in a law. There's some difference in supply and demand from what the market is expecting. I know that somebody's crop just got decimated and that there's not going to be as much wheat as people think that there's going to be. So, that's information, right? And then you take that information and you go and you trade it in the market. And so now that you've traded it, the market should reflect that information, right? And so that's this whole idea is that the market is efficient, that all available information is correctly priced into the current prices. And what we find is that that is not true. That if we have a piece of information and we know exactly how the market should price that new piece of information in, the market does not actually go to that price. It always goes too far or not far enough. So the markets are very not informationally efficient. And it's not until you get to like a 3 to 5 year time span that like that informational efficiency can actually be seen statistically. Okay. So why? And why is that important? Well, so the reason why is because markets are extremely sensitive to new orders, right? So if I come in and I trade this, that has an impact on the market. It has an impact, and that impact is actually 5 to 8 times larger than you would intuitively think. So you would think, if I go and I put $1 into the market, take $1 out of bonds and put it into the stock market, that the market cap of the stock market should only go up by $1, right? That's what you would intuitively think. But they've shown both through they've like come up with the math and the model, and then shown empirically that actually the market goes up like $5 to $8. So $1 actually increases the market cap by $5 to $8. So your impact is way more than you think. This is called the inelastic market hypothesis. Okay, so it's a hypothesis, but it's a hypothesis with a lot of data backing it up. Okay, this is basically like after 150 years or so of scientific research into the markets, this is kind of like the best explanation that we have come up with to date about why the markets behave the way that they do. So that they are inelastic. So like you think about a rubber band, if something is like, if demand is elastic, then that means that as the price goes up, less people are going to want to buy it, right? And so the price is going to come back down. And so it's like a rubber band that kind of tethers you to like what this fundamental price should be, right? Well, what if that rubber band just stretched? Like you go like this, but then the rubber band stretches. Then at that point, the rubber band would just be loose around your fingers. That's an inelastic market. So in an inelastic market, you coming in and buying a ton of something has such a disruptive impact on the market. All of the market makers get out of the way. They don't want to provide liquidity in there. It kind of creates this hole, and you just get stuck in this hole. But it can lead to more buyers. So there's kind of this function where it's going need a larger. So it follows the square root law. So it has really extreme impact here at the beginning, and then the impact very quickly trails off, right? And so what this means is they can't get to the informationally efficient price. Like, there's just not enough liquidity for them to do it. But if there's like a small statistical aberration in there, people pick up on it and try and trade it, and it removes it from the market very, very easily, right? So strong impact of orders means that any kind of strategy you come up with from a technical analysis perspective that actually works gets removed from the market quickly. Like, you can literally, if you find something and you start trading it, and then as you make money, you size up, you will eventually get to a point where the market can't handle it anymore. And other people will notice your order flow and pick up on it and start trading it, and then it won't be a profitable trade anymore. So basically, the point is, the question that you asked was, I'm looking for a trading strategy that works. Does such a thing exist? A popular trading strategy that you can find on the internet that works will not exist for very long. If it exists, it doesn't exist for very long, because as it gets popular, everybody trades it, it gets removed from the market. I know that was like a really long journey to get to that point, but that's kind of where we're at. Now you might ask, well, but how do these guys like Renaissance Capital make money then? Because aren't they using technical analysis and yada, yada, yada? Well, not really. So a lot of these firms, and as far as I can tell, this is what Renaissance Technology started out doing, is they're doing momentum strategies, which are they're looking at like daily data, and they're going into things based on daily data, and they're trading a very large universe of things. They have a ton of different instruments that they're going to trade. So for you to come in and only trade one instrument every day and try to predict it based on the past action that you have is kind of silly, right? Because that stuff doesn't matter. What matters is the people that are going to come in and buy and sell. And if there's something that's going to cause people to come in the future and buy and sell it, and you really know that it's going to move it, then maybe you have a trade, right? So another thing, though, is that there is high frequency trading. A lot of high frequency trading is looking at the order flow, which is kind of the stuff that I teach and go into more, is how do you interpret what's going on the DOM? You really don't completely understand what's going on in the market without watching the DOM. That's why I think it's such an important thing. But there are robots out there competing with you. Now, there are some edges that will always exist because of the structure of the market. That's important to understand, right? If it's just like people's behavior, that will go away. Okay, people adjust to that very, very quickly. But if it's caused by the structure of the market, then it should always be there. It's just you might not be able to take advantage of it. You might not be fast enough. Somebody else might be beating you to it, right? So one of the things that these HFT firms do and so forth is they put a lot of effort into knowing how to size their trades. So they want to know, what is the maximum amount I can trade without tipping the market off, without them kind of realizing what's going on and messing up my signal, and, reduce my competition, essentially. Right position sizing. Exactly. So now that I've gone through all that, do you kind of see why the market is the way that it is? Why it's so effing hard? It's because trading it changes how it behaves. Okay, can you show an example of a trade you would take? Sure. So let's say that I knew something about the University of Michigan Consumer Sentiment Report that's about to come out in about an hour. Now, if I had like insider access to that report, I wouldn't be able to trade on it, right? That would be illegal. That would be considered insider information, right? Insider information is trading on stuff that is not your information to have and trade off of, essentially. Okay, but there can be public information that I might be able to gather from different data sources and so forth, what the consumer sentiment is likely to be, and then trade off of it, right? And if I know that in the consumer sentiment report that consumer inflation expectations have come down considerably, then I know that I can buy here, right? I actually think that is I don't have enough information to feel really confident about this trade, but the trade that I'm talking about right now is a realistic trade. It's a very risky trade. That's another thing. It's a very risky trade, but I think that there is a good chance that the consumer sentiment report will show a lower inflation expectations than is expected. So like they're looking to see a 1 year be 3.1 and 5 year be 3%, which would be in line with what it was last month. And I don't think that that's going to be the case. It's either going to be higher or it's going to be a little bit lower. But given that the way the markets have been acting, I think that has probably filtered down to consumer sentiment and that you'd see slightly lower inflation expectations, right? So I can come in and buy it. All right. Now, once I know what the future flows are going to be, and that's the key thing is that piece of information tells me in the future, in an hour, there's going to be a bunch of people that are going to come in and buy this. If that's my theory, right? Okay. Then the question is, how do I execute that? And that is where what we know about order flow kind of comes into play. So one of the things that we know about order flow is that the price tends to settle where supply and demand are at their lowest. Remember, I talked about the liquidity hole. We had a move down from 09 down to 04. And once we got to 04, the market makers didn't want to put as much liquidity up. So you can see at 111.04 right now, there's only about 800 contracts bid, and nobody's really hitting it. It wouldn't surprise me to see them tick back down and only see 200 contracts offered. And it can like go back and forth like that a ton. If you come over here to a chart and you look at ZN, you can kind of see it on the chart. You see how many times we've kind of gone back and forth across that price, right? It's because the market makers don't really want to put a lot of liquidity there. So like there's only a few hundred contracts here, but then if you right here and right here, there's too many offers, right? There's too many offers above us for us to get through there, and there's too many bids below us to get through there. And so we just do this. False breakout, right? Okay, so that's something that we know that helps us. So I know if the liquidity hole is at 04, okay, 04 and below is probably a good place for me to go long. It's actually may already be too late. It just ticked up. Would liquidity hole show beforehand on cumulative delta percent? Nah, I don't think you'd see it on cumulative delta. The best way to see the liquidity hole is first look for the things that cause liquidity holes. That would be like price slipping through, or large transactions happening in a place, or it just staying at a price for too long. Those are the three things that can cause the liquidity hole. And then look for the low resting liquidity. Watch the DOM and see how much does it take to make it tick up and down across that price. And if it's like less than 1,000, then you have a candidate for a liquidity hole. Okay. So I can buy 04 and below is a good place to get long based on what we know about the order flow, and our expectation is that it's going to be long. And when the trade happens, I would expect there to be 15 to 20,000 contracts long. Okay, so we already have traded down about 15,000 contracts from about 6 o'clock. So that means that if we did get that news and it happened from 04, let's just assume that it was at 04 at the time, probably we could break the highs, right? So I could be like long 2 contracts, take 1 contract off at the high, and then let the last one run, right? And that's an example of a trade that I would take, right? Now, I think that you were looking for a technical setup, right? You were looking for when this is the highest high of the last 30 minutes, so it's a breakout and we're above this moving average and all of these sorts of things, then I take a trade, right? If we're talking about daily data, then those sorts of things are maybe worth talking about. But on intraday basis, it's a crapshoot. So let's try and take this very, very risky trade on a sim account and see what we can kind of pull out of it. Set aside the fact that it might not be optimal or whatever. Well, of course you could create one from scratch with only Rust. So it's a really complicated thing, though. It's probably beyond me doing on my own. I think that making Win and Rust would be a worthwhile endeavor, though. Well, okay, so I'm kind of reading back on the comments here. So Retro says, I have simple strategies making money since month, so I don't know what that means, but on 15-second charts, it only follows the trend and delta using smart money management. So I'm interested a little bit, but like first thing is that my standard, if I'm going to do intraday trading, for me to say like a strategy really works, I want to be able to make money every year for 5 years. That to me is like the level of success I want to see that says you're not just lucky. You know what I mean? So that's the first thing. So probably don't have enough data to say that this is really actually a good strategy or not, right? Now, one thing that we can do is we can backtest it, right? But I have found that strategies on time frames lower than 1 minute and maybe even lower on 5 minutes kind of run into issues translating from sim to live, which is to say that even if you're doing things like you're using like 1 tick data behind granularly and you're checking to see that you'd get filled and things like that, the shorter the time frame is, the less likely it is to go live. And especially when you get into like high frequency trading algorithms, some of those, the approach that you have to take is, here's what we know about the market and here's how we know the market will react to what we're doing. And then to test it, you just have to put it out there because you can't really backtest them on a short enough time frame. Okay, so scalping ranges by reading order flow would be a good strategy, right? I'm not going to say it's a good strategy, it's a strategy. So something that you can do is you can come in here and you can wait for one of these liquidity holes to form and start trading it like that, right? Now, the issue that you're going to run into, number one, is that it's really hard to get filled, right? Like if I think that there's a range here and I want to buy it, so the thing that makes the most sense would be like buy the low end of the range and then take it off in the middle, because you know that you're going to be able to take it off in the middle. If you try and get, like it's hard to get filled here, it's hard to get filled here. And if you do get filled here, you might just be having like what we're seeing right now. Like they're moving lower, right? They're moving lower. In fact, I think that I'm going to say 1, 2, 3, 4, like one more tick, and I think I'm just going to puke this. But, if it's really actually a good range, you might not get filled, right? So that's why it's kind of like not maybe necessarily the best strategy, because it's really frustrating and hard. You kind of have to be at the top of front of the queue to get it, and you'll get screwed over by breakouts. So like you might be able to trade that range 2 or 3 times and make money off of that range, but then if it breaks out the wrong direction, you're going to lose all that. So this guy made 300K trading futures last year. He made 350K in February and lost 50K the other 11 months of the year. Is he? No. Well, so again, my standard is 5 years. Right? So this brings me to the thing that I wanted to talk about today, which is how likely are you to pass a top step combine? Because I don't think that people realize how successful you can actually be randomly, which is to say, if you put 1,000,000 monkeys into a room with typewriters and you have them typewrite until the end of time, eventually one of them will write Shakespeare. That's just, if it's random, eventually Shakespeare is going to come out, right? That's why there's this. Have you ever seen this thing where they have this online archive, and you can search for some text, and you will find that text and somewhere in there. No matter what the text is, it's in there somewhere. It's like all things that could ever possibly be said ever. It's in there, right? That can happen. And if you have a couple thousand traders and they're all trading, trying to pass us a top step combine, and their trading is completely random, there's no edge, and their success is just random, there are going to be some people that pass the combine. Statistically, there will be some people that pass the combine. So what does that look like? And like, how many people could actually potentially pass from it just being random? Well, let's find out. Let's find out. So I'm going to pull up a little script here. Oh, I got out of the directory. Python Monte Carlo. Okay, so here's what we're going to do. It's a quick 80-line script. Okay. Got to import a couple of things. I'm using matplotlib to graph stuff, and I'm using NumPy. That's a requirement for that. Okay. And then I have a couple of variables here at the top. I'm going to say simnum. So what I'm going to do is I'm going to say how many top step combines, how many traders are we going to have? We're going to have 10,000 traders. So we're going to do this. 10,000 traders are all going to try and trade, and then we'll see how many of them actually pass the combine. That's what we're going to do. Okay. And then each one of them is going to trade 200 times, and we'll see if they either get to the target or the drawdown limit. I'm not factoring in things like, you lost more than $500 in a day or anything like that. Let's just assume that they take like one trade every day, something like that. Okay. And if they come to the drawdown, then they're out. Okay. Now I will define set targets. So in this instance, we're going to say when we win, we're going to make 2 ticks on the treasuries. And when we lose, we're going to lose 4 ticks. So we have an R factor, is what I tend to call it, but this is your risk reward. You have an R factor of under 1. Right? And then the win rate that we're going to get from that R is going to be if the strategy was break even in the long term. So that is to say, because my loser is further away than my winner, my win rate is likely to be very high, because it's much more likely that I go to my target than that I go to my stop. So I am picking a win rate that still makes that break even. So that when you say, my winner times my win rate minus my average loser times my losing rate equals 0. It's break even. So if I traded this for, 1,000,000 trades or whatever, theoretically it should come out to be close to 0, right? Okay. Then I have a couple of other things in here: max drawdown and the target to determine, when they've passed or failed the combine, and just numbers to keep track of, who's won and who's lost. Okay. So then what I do is I do the trading. So for each trader, when we're doing the simulator, for each trader, he's going to take 200 trades. That's what this means. 4J in range trades. That basically means do this 200 times, right? Now I have this commented out. This is actually the code that we're going to talk about. This is a scale out strategy right here. We can talk about the scale out strategy in a second, but this one is just, okay. So if we're going to pick a random integer, and then if that random integer is above my win rate, essentially. So like, if it's over 666, then it is going to say that was a loss. and otherwise it's going to be a win. So that's how I'm going to get a win rate of 66% to account for what my R factor was, right? If my R factor was 1, that is my average winner was equal to my average loser, then my win rate would be 50%, right? So then we come in and we say, okay, so if it was this one, then you add, whatever my winner size was. That's 31.25, 2 ticks in the treasury. And I'm going to add that to my overall profit, right? And then I'm just going to keep doing that until you either get to the target or you hit the drawdown. Now, to find the drawdown, I have to keep track of like what the high water mark is. And this right here is keeping track of the high water mark and then calculating what the drawdown is from that high water mark to determine if you've hit the drawdown. Okay. And from there, this is all just graphing it. Print a couple of stats out here, and then I create a chart and print the chart out. Okay. Is it worth learning to code? I think so. I think it's really powerful that I can just, on a whim, come in and do this and show it to you. I think it's really cool. Okay, so it prints out a graph. What do those graphs look like? Oh, that's not the one that I wanted to look at. Yeah, here we go. Okay, so here is one, and it says, if our R factor is 0.5, that is, your average winner is half your average loser. Okay, then 24% of traders will pass the combine. Can you believe that? When I first did it, we just went back through my code. So if I did something wrong there in my code, let me know. But I've checked it many times. This all seems accurate. Theoretically, just based on randomness, 24% of traders should be able to pass. I don't think that many traders actually pass it. Right? But just based on randomness, a quarter of traders should be able to pass the combine. So next time you see somebody saying, well, I'm a funded trader, that means I know what I'm doing. Just keep that in mind, right? If 1,000 monkeys were in a room for all eternity with typewriters, eventually one of them will write Shakespeare. And the news media will take that monkey and they'll try and understand what is it about this monkey that makes this monkey successful. What is the monkey's daily routine? What forms of analysis is this monkey using? And the reality is that it was random, right? So basically what I'm saying is when people tell you they're a funded trader, what it means is they're a monkey and they don't know it, right? Super interesting. Now, another thing that I find really interesting about this chart is that most people actually fail right away. Like, do you see how there's kind of like this cone? See how there's kind of this cone? Isn't that interesting? So, like, the people that are failing out, actually, this down in here is like 70% of people. Isn't that wild? Isn't that wild? You make it sound like profitable retail trading is not possible. It's not that it's not possible. It's unlikely. It's unlikely. I guess the issue here is that kind of what I'm saying is you can actually make money just randomly, right? There can be absolutely nothing to what you're doing and you just get lucky. And a lot of the people that are out there teaching and stuff, that's what happened, right? Was they're trading something, they came up with some theory, and then they had some success, and then they say, that proves that all of my theories are correct, and then they go around and they teach it to other people. But the reality was, it was random, and they don't know that, and so now you've just taught a bunch of people something that's random. And like, it'll just keep going on, because like if a quarter of them can go and pass a combine, then it kind of perpetuates, right? Because the reason we brought this up was because there was people, they were arguing with people in the Top Step room. So this is for you, Top Step. Okay, all you guys, you think that you know, passing the combine proves that this smart money concept stuff works. No, it doesn't. It just proves that you're monkeys and you don't know it yet. Because statistically speaking, if it's just random, according to this Monte Carlo simulation, 24% of you should be able to pass. That seems kind of significant, don't you? Don't you think? I'm going to bet you that not 24% of retail traders pass the combine, which is also very, very interesting. But now, this doesn't mean that all profitable trading is random, but what does it mean? In order to prove that a strategy is truly successful, that it actually works, you need a lot more data than people realize, essentially, right? You need to get into like something where if I'm backtesting it, can I get 10,000 trades out of it? If I have a sample size of 10,000 trades, because think of it like this way. We've had this conversation a few times, but let's just say that you have some strategy that has a 1% edge. That is to say that like you win 52% of the time and you lose 48% of the time. Okay, so that's a difference essentially. Sorry, not 51. 52. You win 51 and you lose 49. Okay, so that's a difference of 2% essentially, right? So a 1% edge, so you're getting 1% on the side and lose 1% on this side, it becomes 2%. Okay, so that means that if I took 100 trades, I would have 51 win and 49 lose. Okay. If I do another 100 trades, how confident are you that it would come out to 51 winners and 49 losers again? Well, I wouldn't be very confident. That's only 2 trades. And you're telling me that there's not enough randomness in the market, you know, for a margin of error of 2 trades? Right? You're going to need an edge a lot bigger than just 2 trades, right? So in order to prove that this is actually an edge, even if it's just a 1% edge, we need more samples, right? So think of it. Now, if we have 1,000 samples, now you're talking about a difference of 20 trades. So can you imagine that? You take 1,000 trades. 1,000 is a larger number than we really have the ability to conceptualize. That's a big number, actually. 1,000 people is a lot of people. And you're telling me that 20 of the trades are all of the profit from that? That's not very many. So then, what if it was 10,000 trades? That's the number of samples that I did here for this Monte Carlo simulation. Okay, now you've got a difference of 200. Now you're kind of getting into like statistically significant numbers. But it would probably be even better if you could do 100,000 trades and have a difference of 2,000. Now you have something where you can say, there's an edge to that, right? There you go. Okay, so when I teach something to you, of course, there's like my experience and how I try to approach things, and I try to make it clear when that's just me versus something that's proven. But when I say something is empirically proven, I'm saying it's been done on market data with a large number of samples. a large enough data set to prove that there really is a statistical anomaly there that is outside of the margin of error. This is what that means. And most, like, a one trader's performance over a few months or a year is not enough to prove that sort of a thing. Now, this does not mean that profitable trading is not possible. It is possible. It's very difficult. You imagine doing that for 5 years. I have never met them. Okay, the person that's doing intraday trading, like they're doing day trading on futures, and they've been successful every year for 5 years in a row, I have not met that person. So I'm not trying to argue that profitable trading is random or like true profitable trading is not possible. What I'm trying to argue is it's extremely difficult. It takes more data than you think to really prove something, and that you shouldn't dump your life savings into it. That's what I'm saying. Right? If you're like me and you love this stuff so much that is just, it's what keeps you going, man. You just want to know more about the market and you want to be involved in the market, and you're okay with only risking small amounts and not really getting paid a whole lot for it sometimes, then you're in the right place. And I'm going to teach you everything that we know about the markets that we can prove. And then you can go and take that information and you can learn how to do your own kind of statistical analysis, like what I just showed you here. This is a Monte Carlo simulation. These are useful. Go and find your own edges that nobody else knows about. Learn to size your trades correctly, and maybe you will actually find something. And that's kind of the goal. That's kind of what you're going for. Fair enough? Fair enough? Yeah, my understanding is that, well, so it kind of varies by broker, but I think that if you were to look at like long-term profitability, probably 95% of traders fail. Yeah. Yep. Oh, you know what? I was supposed to put a stop in here, and oh no, actually, I 1, 2, 3, 4. Yeah. Stop. Reality is pretty depressing. Yeah. I know John Grady and Gary Norton, but I've never seen their trading results. Here's the thing. I have an open invitation. If you know somebody or you are somebody that has been doing intraday trading on futures and have been profitable 5 years in a row, then I want to talk to you. Anybody's performance that they can't show me that, it doesn't matter, right? Because their success or lack of success could be random. There's no way for me to really know, right? Once I get to like 5 years, that now I know there's something to it. Now, the thing that's funny is like let's say that there was some guy with a YouTube channel that was teaching stuff on that YouTube channel, and he had the broker statements out there to prove that he was profitable in the last 5 years, okay? I would not be saying, okay, everything that this guy says on his channel is true, right? We know that at that point, there's something that he's doing that's making him profitable, but that doesn't necessarily mean that it's the stuff that he thinks is making him profitable. That's another kind of really weird thing about it, right? Is some of the profitable traders don't actually understand why they're making money. and I see that a lot. And it could be this really seemingly innocuous thing that you're doing that has absolutely nothing to do with what you actually think is causing the edge, right? So once I got a person like that, what I would be doing is I would be trying to pick their brain and trying to determine where the edge really actually comes from, and trying to prove that that thing actually is an edge. So they say, well, I trade this strategy and this is how I do it. And then I would go back and I would say, well, can I actually test that against the market? Let's go and test that against the market and see how that performs. And it should perform the way that he performed. And then I know that I've really got something, right? That's exactly it, Retro. I now know why you have only 20 viewers. You are just too honest and realistic. You know, I think that's it. If I just sold people on the dream, come and watch my stream every day, we're gonna make you millionaires, I'd have all of these people. Probably. I'm a little miffed that as soon as I took that trade, that's when it decided to bust out of the range. But I guess it kind of proved the point that I was trying to make about that. That's like, you can make a little bit of money across that range, but if you get stopped out, it's going to be ugly. And we still got 30 minutes before the University of Michigan. Although I'm kind of wondering, well, I don't know. 111 is kind of a key point where we've kind of been sitting a lot lately. So I don't know if that move down was significant, but one possible explanation for why we saw the flow that pushed us down, and there was about, it was only about 5K, so I don't know if that was significant either. But maybe somebody is trying to sell ahead of the University of Michigan. That could be possible. Could be possible. I could list it as a theory. I don't think that I have enough data to really make me feel very strongly that that's the case. But it's just kind of something on my radar. Let's say I copy the code from one DOM and use a converter to turn it into Rust. No, I wouldn't work that way. I think. So my first question is, why would you want to do that? Like, why would you want to take the one DOM and convert it into Rust? Like, if you have a DOM out there that you really like and works, then why not just use that one? That's why I'm kind of like, I'm not 100% sure. I think that I could make money from making a trading platform, and I think I could make a really good trading platform. And I think that getting the DOM right is kind of like one of the biggest impediments to me making a platform, because it's like, that's one thing that I would have to have in my platform to make it a usable platform. But that would just be getting me to break even. That would be getting me just on par with other platforms. And it would be like the machine learning and statistical testing sort of stuff that would be built into the platform that would be the actual edge, you know? And so I would rather go and like make that platform and you've still use Jigsaw or Sierra charts, you know, because those DOMs work. And I don't know if writing such a DOM in Rust is like objectively an improvement. I mean, it would probably be a little bit more performant than Jigsaw's, because Jigsaw's is written in C#. Probably use less memory and stuff. But, and then the other thing is that like to convert them, you got to realize that C# is a garbage collected language. So I would need to be able to come in and design it in a way that I can manage the memory, which may involve completely redesigning what's going on in the back. So I don't think that you using a quote unquote converter would really be beneficial in that. You go with me? I want to implement some specific features that these companies refuse to implement, let alone release API versions. And you can't do it with the NinjaTrader custom DOM columns? James Randi had the $1 million challenge to anyone who could prove they have psychic powers. Nobody was able to claim that money. Trading appears to be similar. You know, I'm going to bet that there is somebody out there that is intraday trading futures and has had success for the last 5 years. But I don't know if they're a person that would even know about us, you know. I'm sure that they exist out there, but it's probably a handful of people, right? Now, if you're trading for a firm, that's a completely different story. And I think that this is where the story, where I kind of am at in the story, is like, okay, I know a lot about the intraday market now and what kind of tends to move things and the limitations of what we can actually predict and so forth. And can I be successful? You know, I don't think that I would ever quit my day job. I don't think that day trading would ever be consistently successful enough for me to do that. But like, could you maybe make $20,000 to $50,000 a year from doing it? Maybe, yeah. But it's super, super hard. Maybe there's better ways. Okay, well, we know that if we just buy and hold, that tends to work, right? So now that we understand the market at its most base level, we can use that as a foundation to do other things. And those other things are frankly better than day trading. Like that's the whole conundrum about it, right? Is like anybody that has the money and the resources to be successful at day trading, why would they day trade? Why wouldn't they do these? There's bigger fish to fry. You build the thing that's great about day trading is how much you learn about the market. I've just taught you like the most deep, confounding things that have puzzled people for hundreds of years about the way that markets behave. Now take that and use it at a higher level. For instance, you could try doing a momentum strategy. I'm looking into seeing if that's possible. One of the issues with the momentum strategy is that in order to be able to size your risk correctly, you need to have a pretty big wad to trade. So you need like $10 million. Momentum strategy is interesting. So something I had forgotten about, like I remember them talking about it, but something that I had forgotten about was that momentum stopped performing. There was a 5-year period where momentum did not perform. And then after COVID, it took off again. Isn't that crazy? So when we're doing like daily chart things, you can have unprofitable years, and you need more like a 20-30 year period to see like how effective your algorithm really is, right? Okay, but you know, if you run a firm, if you're running something like that, and then the things that we know about the market can help you, because you can come in and you can say, okay, I'm supposed to buy it today because my momentum signal has come in. And now how do I execute that most efficiently? And the things that we talk about can assist you in doing that. Right? And you know everything about that. You know all of the, like, here's what the news is, here's how what day of the week is, so that you can kind of time your trades and stuff. Right? And so that you can develop a high level strategy that's more successful, because you're not going to go down these rabbit holes based on things that are just completely incorrect about the market, right? Because you go and manage a momentum fund, right? If you manage a momentum fund, you could manage a $10 million fund and like basically double the size of the fund over 10 or 20 years and still pull $10 million out of it for yourself. Like, it's crazy, right? There are way better gigs than intraday trading futures. That doesn't mean that trading futures is not worthwhile, but I think that the primary benefit that you get from trading futures is what you learn from doing it. Yeah. really, this is all just a cope to deal with the fact that I have not traded very well the last 3 months. Right. I think there's enough add-ons like Jigsaw for Ninja Trader if you want to scale. Oh, I mean, it would come down to what the specific thing that you want is. But you've just got to realize that writing your own DOM is a really, really big project. Especially if you do it in Rust. If you do it in C#, there are data grids and things like that you can take advantage of. I think that Jigsaw kind of started that way. And, you could probably build something a little bit faster. In Rust, it'd be hard. You'd need a team. I would need a team to do it. I think one of the real conundrums that we have in that space, because unless I can program just about anything, if you give me enough time and money, give me like $2 to $5 million and I could probably build you a pretty great platform. But it's just, I lost track of my thoughts. Oh, yes. Okay. The kind of the conundrum with development. So I can make just about anything that you want, but you're gonna have to pay me for the time, and you don't have any way of knowing anything about how it's actually going to perform until after I've programmed it, right? Unless you have some sort of a model, right? So if you have a research paper and it's here's a model in this research paper that I think I can turn into an indicator and try to trade. Now you got something. Now you got something that's oh, okay. That would be worth paying somebody to go and make for me, right? How to monetize day trading without trading? I don't know how you do that. Not without, Of course, what you can do is you can just lie to people and say that you've made millions of dollars from doing this and anybody can do it. And all you got to do is buy my course and you sell the course and then you could make money from it without day trading. Yes. Mm-hmm. Yeah, Greg. So what about looking longer term? Well, that's kind of one of the things that I'm saying is that some of the things that retail traders are trying to do, they would have more success with if they were at a higher time frame, and particularly daily charts. Okay, these things. If you've got something on daily charts, now you're talking about something that could be worthwhile to start a fund with. Now there comes back to this other thing, which is what we're doing in what I do here on this stream is so limited. You got to understand. It's so specific. I mean, we're trading treasuries and that's probably the most important market in the world. So don't get me wrong. I mean, there's important things about it, right? But there's other instruments out there. There's other time frames out there, et cetera, et cetera, et cetera. And it's once you get into, I'm going to look at what it's doing on a daily basis and take advantage of inefficiencies in the market that persist for days, if not weeks. And I'm going to trade 100 different instruments and take advantage of the risk reducing advantages of multiple assets and having a whole portfolio of assets, right? Now you're really talking about something that's valuable. Shane, you're gonna have to link the study to me. That's one I haven't heard of before. Statistical inference. Treasuries are among the least traded in. Yeah, it really is, which I think is pretty wild. Was there ever a point where you mistakenly thought you cracked the code to profitable trading? Well, no, I think no. So I think part of the deal with me was that I kind of started this out being taught by a professional trader. So the way this happened was the 2008 crisis happened and I got interested in the financial markets. But I was basically done with school. Like that happened like the last year of my school. So I was going to be a computer scientist. I was going to make video games. I thought I was going to make video games. But I realized that the video game space sucked to work for and that it was a way better gig to do finance. So I said, well, it's too late for me to go back and change my major, but I can go into finance, right? So I went and worked for one of the big banks. And so I didn't trade for them, but I got a lot of insight into the markets and I learned a lot because I had access to like the institutional research and all of that sort of stuff while I was there. And there was a few occasions, very, very brief, but a few occasions where I had the opportunity to talk to traders, particularly the traders in the block trading areas. And, they were like, there's way too much for me to teach you in one afternoon, right? But they kind of gave me the main conclusions. So I always kind of knew the end results. And then after I left the firm and I had the ability to actually trade, because when I worked for them, I couldn't day trade. They basically limit you, like you have to hold it for at least a month if you buy anything, and you definitely can't trade futures. So when I left, then I went out and I was eventually able to find the empirical research and kind of understand all of the things that they were telling me. And the real first thing that they told me was, trying to be successful as a retail day trader is incredibly hard. So, and that you need a lot of data to really prove it, that you've really got something. So I always knew, but I've definitely had my moments. I would say that my moments are little, like the best moments were ones where like you just cut a trade and it just really, really went right. And the whole time period from about last August until the end of this summer, so that was a solid 9 months, I did really well. And, on these sim trades, I still do really okay, I guess I could say. So I certainly have my moments. But I know ultimately that, would I want to live on it every month? No way. That would be a nightmare. It's kind of the thing. So I made a video yesterday on TikTok about people complaining about the robots are going to take their jobs, because I'm seeing a lot of that, and especially big tech people, because there's a lot of big tech layoffs, right? But I would argue that when the wheel was invented, people were probably upset about it, right? Probably all these guys sitting there like, we'll take Grog job. I'm telling you, it happened. I bet you someday there will be archaeological evidence of somebody complaining, lamenting the invention of the wheel and how it's going to destroy humanity and the economy and all these sorts of things, right? It happened. The robots will take some jobs, but the result is always a better standard of living, better jobs, right? The jobs that are available to us today are better than the jobs that were available 100 years ago. They are, because they're more productive, and that means that you can get paid more. And things are cheaper. You like that a phone that is more powerful than the computers that landed man on the moon fits in the palm of your hand and is only $1,000 is just absolutely insane. And it's only going to get better. So why am I getting into that? Well, the robots took my job, man. That's what really happened. Was I got into trading, and unbeknownst to me, at that very time, the industry was undergoing a transformation where the robots came in and just took over almost all liquidity provision. The robots took my job. They did. But that just means there's better opportunities, right? So now I have, what do? I keep all of the robots running. And I get paid really, really well for keeping all of these computer systems running and making them more efficient. Because of the robots taking over, it actually has provided me a better job overall. Because like I said, like maybe if you were retail trading and you were doing liquidity provision, like could you make $30,000 to $50,000 realistically? Sure. But that's like not even a third or a fourth of what you could get paid in tech, right? Or you can make your own robots to provide liquidity and maybe make more. Or you could go on to higher level strategies and run a fund. And now you're talking about things that can make you millions of dollars, right? So the robots took our job. We have to adapt. Why did I do stupid trades? Yeah, because we're stupid. Although I have to be, one of the things is that oftentimes when we're having bad trading, we will blame it on something outside, or we'll blame it on ourselves. And I find that more often it's actually inherent in the strategy. Like, there may be something about the way that your strategy works that is kind of encouraging you to take off plan trades. But what happens now never happened before. People cannot compete with AI and robots anymore after a few years. Well, there are certain jobs that are going to go away, sure. There are jobs that are going to go away. You're still going to have an economy, right? Like, people still have to pull materials out of the ground and turn them into robots and stuff. Even if the robots are doing that, somebody has to tell the robots to go and find them, and you have to find the minerals and all of this sort of stuff. So, yes, there will be some jobs that you won't be able to compete with the robots, and it will just take them over. It's going to happen. People are going to be displaced. But it just means that there are going to be better opportunities somewhere else, right? This always, we've been through this so many times, it always results in more opportunity, better standard of living. And like, especially if we can get robots to the point where like they're building houses. Imagine a world where a house is like, you know, $10,000 instead of $1 million. Okay. Like we're talking about making things orders of magnitude cheaper. The impact that it's going to have on your life is just unfathomable. And it's so wild to me that everybody assumes that it's going to be like the end of humanity. It's kind of silly because it never works out that way. Yep. I wonder how the old floor traders felt once electronic trading started taking off. Oh, well, we know because they made many documentaries about it, right? It's kind of funny to me that the time period where the day trading thing was like the biggest in popular culture, and where we get all of these ideas about what day trading should be like, this dream that people are chasing, that came about at exactly the time that the electronic trading came along and destroyed the trading floor. I think about that often because it seems to me that, first of all, most people that tried to be floor traders were not successful. Still, the majority lost. But then there was a lot of these guys that they were successful with it, and they did it year after year after year. But they were not millionaires necessarily, so some of them were quite humble. You get one or two that will like do really, really well, and then they become rich. But a lot of floor traders were just working class kind of people, is my understanding of it. And they can all go and be site reliability engineers. Totally. There's probably enough. It's probably created enough jobs to employ all those people that used to trade on the floor. But there's video document. Like if you just search on YouTube for documentaries about floor trading, you'll find them. They talk about that stuff. Would you have liked to have been an old school? I would, but I don't know if I would have been successful at that either. One of the things I understand is that for old school floor traders, being large in stature was a really big edge, and I'm not. I'm average height, but I'm actually very, very thin. Well, let's not say thin. I could probably lose 10 pounds or so, but I'm not a thick boy. I'm a slender man. Okay, so it's time for the news here. So I'm gonna try and take that trade that we were talking about earlier on the sim account. Okay. Stilts, bigger boots. I know I can talk pretty loud and yell really loud. That would have been an advantage, but I don't know if I actually would have been good at it or not. But we'll never find out. The reality is that I am better at computers than I probably ever could be with trading, unfortunately. Okay, so here the numbers coming, and we have University of Michigan 1-year inflation preliminary 2.9 versus 3.1, and 5-year 2.8 versus 3. So I was correct on the numbers. Will I be correct about the degree, the number of orders that I want to see come into the market? We've had a little bit, but I do want to see it to come up to 09. Nice call. Thank you. I understand that was like a very, very speculative play, but can you see how, yes, it is possible for you to use information that is public out there to predict things that aren't priced into the markets? Yes, it's hard, and that one was more speculative than I would like. In fact, like, look, it's not going the way that I want, so. It did jump, but I'm not actually seeing the flows come in that we want. So that's kind of interesting. What else? Existing home sales was less than anticipated, 3.78 versus 3.8. And sentiment was higher than anticipated, 78 versus 70. So there may be that even though inflation expectations was a little bit lower than expected, they may be concerned about the top line sentiment number, and that may be why this isn't just completely going for me. Anyways, I was going to say, I hope that kind of shows that it is possible. It's just like, it's super difficult, right? Especially to do it consistently. Because that's not a setup. That's not a, every time you get this situation, you do this thing and yada. No, it's something that's going to be different every day, right? Now that's what makes it repeatable. That's what makes it sustainable, right? Because if it was a statistical sort of a thing, then it would get arbitraged out of the markets. But because it's something that changes every day, that just makes it even more difficult for the markets to handle. And that's one of the places where, like, the robots can't really compete, right? Perhaps that's where it's like, if I worked at a firm and I had all of the firm's research and resources and so forth, I think I could probably do pretty okay with it, right? We should stand at our desks and yell our orders out loud every time we click a trade. I would really like to see somebody use VR to make a trading floor. I think that would be super interesting, because I think part of the problem with a floor was like, okay, I'm going to trade with you. I got to write your number down, and then you don't write the number down correctly, or people misunderstand, and you've got all of these other people that are like, the clerical people, like trying to sort all of that out and fix things and everything, right? Well, if you had virtual reality, now you have the benefits of electronic and the benefits of the trading floor. And wouldn't that be cool? But I don't know. It would be something that should have happened already. Oh, there's the... Yeah, I'll try and take a look at that paper and see if I can write it, if I understand it. It sounds like something over my head too, but when it's over my head, you know, sometimes you can just be really stubborn and just keep plowing at it, and eventually you figure it out. Okay, well, it's been almost 5 minutes and I am not getting the anticipated flows, so this, I think, is maybe one of the advantages of the discretionary way that we trade is I have a prediction for the flows. If I'm not seeing it, then that must mean that I'm wrong, right? So I can limit my losses like that. I'm kind of keeping an eye on it here because it is... Nope. Was hoping that I'd be able to scratch it, but it looks like I might just have to take a small loss. Well, that sucks. And the other thing that sucks is that it's a Friday, so now you're probably going to see the activity like really die down a lot. Although, let's see if they're doing other stuff. Well, the dollar may be looking to make a move. Where are we at on the daily chart here now at this point? ZN. We are kind of like at a momentum kind of state, so it could just be the momentum trading coming in and causing us to sell. Because it really does feel like they kind of ignored that piece of news. Like there was a spike in the price. Yes, there was a spike in the price, but not in cumulative delta at all. It doesn't look like there was a whole lot of order flow that came through based off of that piece of news. So even though I was correct about the number generally speaking, I was incorrect about what kind of flow it would cause. I suppose I could, you know, I don't know if I really want to take risk over here, but I am kind of looking at this now and starting to think that there might come down to that 26. Maybe a little bit of a hole at 29, although I feel like it's a little bit too early for them to be stopping yet. So there is really large transactions happening here. Wow. I should have done it on the live account. Right. This is great. I hope it's entertaining for you guys. I kind of took a big loss earlier in the week, so I'm a little skittish about putting my money at risk at the moment. So that's why I kind of decided, oh, I'll just do it on sim here. But I could definitely see where it was like, okay, so this one's a really interesting setup, right? Because here I had an expectation and I was right about it, but then I didn't see the flows. So now I'm coming back and I'm like, well, what else could be going on? Well, I know from a daily chart that momentum traders are probably going to start doing stuff once we get kind of below this 111-ish area. And we did. And then they ignored the other stuff that was going on. That kind of makes me think that they're just going to continue selling. And then sure enough, you started seeing it. And when I started seeing all those big icebergs around there and everything, that kind of made me think, okay, there is something going on. There is some big guy is doing something. He's just not reacting to that piece of news. So then I, went along with it. Yeah, I do see the iceberg. I don't know if, and I am thinking about taking the one contract off. It's too late now. But you're right. Seeing the 27, I probably should have moved my order up. So it's going to be interesting to see if this is really like a real momentum trade, then there's probably a lot more to go. Okay, Alligator says both ends need to follow now or else it will reverse bear state. Okay, so let's see here. I am seeing flattening. Okay, so then the concern here in this situation should be for me the 30-year. Still seeing big trades on both sides there, man. Big iceberg on the offer at 28. I'm curious to see if they ever get a downtick, how many contracts it takes, though. Well, so they kind of got through it there at 28. So let's call that a 7K. Okay. Ah, interesting. So that time the iceberg wasn't there at 27. So that makes me feel pretty good here. It is still doing a little bit there at 27 though, so I could take one contract off there. In fact, okay. Take that one off. We may still trade 26.5, but I think I'd rather get that off there first and see if it goes through here. So the place, is what's been one of the things that's been frustrating me lately is like, so the spread still seems to be working against me. So, the spread is this, right? Oops. Spread is this. The 5 years moving down more. So you're going to sell the 5 and buy the 30. Which means, because this 10 is a little bit more like a 30 year, I could have gotten in at 18.5 and made 19.5. So I could have made 10 ticks over here. But I made 1, 2, 3, 4, 5, 6 ticks over here on ZN. So normally a move like that would be more like 15 to 20 ticks over here. So the spread's kind of working against me a little bit. Now there's that big old honkin' order at 26 that there definitely seem to be making note of. Well, I mean, it came right to it, a little bit traded into it. They tested it at the very least. But we're kind of like in no man's land, like, if this really gets going, there's no telling how far it could go. Why can't I trade futures on Thinkorswim? My account balance is 2K. I don't know. I believe that Thinkorswim has certain margin requirements and that you have to have like $20,000 in there or something like that before they let you do margin. But really, if you want to trade futures, I would highly recommend getting a platform and broker that is specifically for futures. The futures platforms are just like straight up better than other platforms. Like Thinkorswim is great, but I think that the platforms that are made specifically for futures are better than that. They have better charts and stuff. Well, they're still kind of toying with it here. I think that I'm going to... Oh, wait, what happened there? Oh, that's interesting. I collected at 27.5 and it immediately filled me. I think that doesn't make much sense, but that was a tick up, so now that would be filled. Yeah, that was a good one ticker. So now I'm doing what you were talking about earlier, right, CryptoPop? So I'm saying there looks like there's a little bit of a hole forming here. I want to be short, so if I can get it here and here, I take it off here and then take it off in the middle of it, right? And I saw a situation there where, it looked like the liquidity was pretty likely to pull in there and everything, and I could just get a tick. So I wouldn't say that trade is like a net winner over time. Just because when it's wrong, you lose more. And, it's really hard to manage because it's so tight, right? But combining it with other things that we know, then it kind of becomes useful, right? In this case, giving me a little bit more room to be able to try and let this trade run. I don't know if I'd want to add one if it came back up to 9.5, but like I can come in and say, if we get back to 111, I will stop out of the trade, right? So let's read Zero Hedge's story about the University of Michigan number. Do you only take trades in ZN these days? You mostly. I used to trade ES a lot, but I haven't lately. I guess I could. But ES hasn't been the best trade lately. It's been really tight. Maybe that makes it a good trade because I can trade the range, but... Okay, let's read this. After soaring in October and November and crashing back to Earth in December, consensus estimates for the University of Michigan inflation expectations in preliminary January data were basically unchanged, but instead they declined further to 2.9% for 1 year and 2.8% for 5 year. This lack of fear of inflation sent the sentiment indicator soaring 9.1 points to 78.8, the biggest monthly advance since 2005. The current conditions gauge rose 10 points to 83.3, and a measure of expectations climbed to 75.9. Both were the highest since 2021. Sentiment has now risen nearly 60% above the all-time low measured in June of 2022 and is likely to provide some positive momentum for the economy, Joanne Husu, the director of the survey, said in a statement. Consumers exhibited stronger views on multiple facets of the economy, suggesting greater confidence of a soft landing. Improvements in inflation expectations have been supported by perceptions of easing price pressures in buying conditions for both durable goods and vehicles, she said, adding that consumers increasingly expect the Federal Reserve to lower rates this year, but not housing. That's consistent with the belief that inflation will not accelerate in the near future. Survey showed a pickup in optimism was broad, with improvements across age, income, and political affiliation. More than half of households expect their incomes to grow at least as fast as inflation, the highest share since mid-2021. Meanwhile, stock market expectations were the strongest in more than 2 years, the report showed. Consumers' perception of the current financial situation rose to a 2-year high, while expectations for future finances climbed to the highest since 2021. So then the Zero Hedges comment, are animal spirits coming back? The Fed should be careful what it hopes for. I put that stop up there and they're like, okay, that's where we have to go to make sure that Seth takes a small loss on this. Oh, okay. Let's see here. When did we have these next Fed speakers? Not until after the stream is done. It's Dally, so Dally's in like 45 minutes. The algos are coming to get you. Well, I'm gonna add a contract right there. So I'm still kind of looking at this and thinking about it. Okay. So I'm going to try and be really tight with this one. You know, normally I really try and let them ride if I think I can get them to do it. But in this situation, I don't know if I'm even going to get more than just like the other side of this range. So... DW Indy, what are you talking about? Oh, you know, I forgot about that. What was it that we were doing with that? I don't even remember now, dude. I spent a little bit more time than I probably should have kind of getting that graph to look right for the Monte Carlo thing I showed you earlier. Oh, that's right, the Durbin Watson thing, yes. Nah, I haven't touched it. So my research has been going into the momentum stuff. I've been reading a book. I'm not done reading that book. I want to finish that first. And I'm studying for the series 3, right? That's like what, 2 weeks away? I think it's on the 31st. Let me double check that. I need to make sure I do some tests this weekend. More practice tests. Yep, 31st. Okay, so the book I'm reading is called Following the Trend, Diversified Managed Futures. By, I forget what this guy's name is. That was starting to look really good for a second, but it's just kind of stopped here now. I think I give it just a few more minutes, but I'm kind of starting to see in the end that like the volume is just like gone dead, so I don't like that. Yeah, that was the one that I was talking about on Discord, I think. And you know, it's been a good book because you can tell that the guy that wrote this thing is somebody that managed to fund like this. So I don't know if that kind of move was driven by the dollar or not. I'm kind of starting to get a little suspicious about it. How do you actually... I don't know, man. I think one of the keys for me has always been finding what the right term is, right? So, like, once I figured out that, you know, like, what actually is momentum and, like, what are the models that we're talking about here, then I search for that term and I can find books about that specifically. And that's how I'm able to find things that are a little bit more serious rather than the kind of like pop trading culture trash that most people read, right? Well, Seth just can't catch a break, man. Thought I had a pretty good entry for, you know, a pullback continuation sort of thing, but no, it's turning up. I am kind of starting to see like pretty random flows. There was a little, I am seeing a little bit to make me concerned that ZN is turned around and is maybe just straight up buying, but what are your intentions on the Series 3? I don't really know. Am I going to start a commodities trading pool or something? I guess. It's kind of like, I don't really know where I'm going. You just start walking in the general direction and see what happens. So we'll get it and we'll see what happens. as I'm watching this, I'm trying to sort out if this little rise up here is a opposing meta order buying it, or if it's just the mean reversion. And I'm starting to see some things that kind of suggest to me opposing meta order. Well, I wouldn't put too much stock in the pattern sort of thing. What matters to me is what are the orders going to do, right? So like when I come over here and I look at this and I saw, so before it was like flat and I'm like, okay, but now it's just barely enough to make you say maybe somebody is buying it. That can like flip around real quick, but you know, I'm concerned that it continues to do that. That the cumulative delta just continues to be gentle buying. Because what I should see is like, okay, so here was the meta order that was the sell, right? And then they stopped executing right there. So then there should be a mean reversion period where it comes back. And then maybe 45 minutes later, so like at the top of the hour, like 9 o'clock, right? They'll sell it again. This is kind of what I'm looking to have happen. But if I'm seeing this, that kind of makes me worried that somebody's taking the counter trade. And that would work against us. So that's kind of what I'm watching at the moment. Kind of come back to where it started, though. So that's good, I guess. Do you use any moving average? Not intraday, no. I've tested a lot of them, but those things aren't very effective on intraday basis. On longer time frames, I'm still kind of messing around with it. No, I kind of started with something else, and I should probably go back and try and use the see what is the best filter. Okay, so it's 29.5 now, huh? Yeah, I see it. Okay. Yeah, simple moving average crosses can be good sometimes. So from what I've seen, there is some evidence for momentum on daily, weekly, and monthly bases. It seems that like the macro changes that may be starting to cause a trend can persist for months, but also that, you know, the amount of liquidity that is required out there is just not enough, and so it, you know, it moves it quite a bit over time. But on an intraday basis, they don't work very well. You just get a large enough sample size that moving average crosses and stuff like that, it's not a profitable strategy. And I've tested like that countless ways. Okay, so another 2 ticks up again. They had to push through a little bit of liquidity to do it, though. Okay, so I liked that it took 2,000 to get at 30, but then 1,000 at 30 half. So it kind of seems like it's still like slightly tilted to the upside. Maybe you pull back to the VWAP, maybe. 111 is a pretty even number to have the VWAP at, isn't it? That's interesting. There's a machine gun at 31. Well, it looks like I'm gonna stop out of this. Oh, I need to have two because I had another contract over here back then, huh? Actually got a little bit of pushback here on this, so don't think I have to panic yet. Is this guy that has written the book named Andreas Cleanout? Yes. That's exactly it. And he there was like a new version of it released in like 2021, so wait, I can't find it on DC anymore. I don't know where that is. It's not a very expensive book. It's also not like a super long book. It's like maybe a 2 or 3 hour read. Oh yeah, but no, that's the right name. Yes. I thought you were looking for the book itself. Well, I tell you what, I find the market continues to be a little frustrating to me, but maybe that's because what's going on is really just random. I don't know. Because it kind of seemed like, you know, they were just ignoring the headline news and selling it anyways. But then like that flow didn't continue through and you're getting really hard pushback against it. So not, didn't have very much to go on to begin with, but it's just not turning out my way, right? So I'm gonna puke that. I was really hoping to catch like a small little winner today, but so now that I did that, I'm just gonna like sit on it, right? I won't take another one over here in the live. How much did that go in my favor? 4? Man, really? I don't know, man. Open 823.13. Huh. So you can see I got in like right here. I don't know. Maybe I should have heated this big order here a little bit more than it did. Although, if we, well, let's just say that this start order started up here. Yeah, it does look like the inverse sine law. It looks like I was trying to trade a pullback, or sorry, a breakout right when it started to turn into mean reversion mode. That's the other thing, is that sometimes it feels like I take it at exactly the wrong time, but I think in that one it wasn't the case. I think that the trend had already kind of started, and then I thought that I started to see the resumption of downtrend, and that it wasn't, so. Yeah, alligator says, well, okay, Warden. I'm trying to think of what I should have done differently, but I think that the big thing was that I just didn't have a strong enough signal on that one, right? This is kind of speculative both ways. I thought maybe momentum would continue through, but if it's like so speculative, then maybe the flows that you're going to see are limited, and that's why it's kind of confusing to me. Donald Trump Jr. says his father may tap Tucker Carlson as a running mate. No. They've clearly talked about it, but Tucker Carlson has said no. Okay, well, that's the first time that I've seen, like, counterflow, so. At least since my trade stopped out. Man, I don't want to let that one like get me down, but it's like I really feel like I just can't catch a break. Jeez. Like I'm on a really awful losing streak right now, man. So it's good that, you know, just take the small loss and move on, but jeez. Jeez. I mean, I think overall I'm happy because we had a lot of good discussion today, and I feel like I made a difference for some people, so... Debacle. I do kind of wonder what's going on here. I'm the level 2 activity is still pretty high for this time of day on a Friday. Well, the one down here in the micro, I lost $10 on it. So not the end of the world, but I did lose money on that one. This other one up here, that was sim, yes. Otherwise, it was like, came in and I was like, okay, like I'm just going to take a small one contract, equal risk reward. Just didn't work, you know. I'm on a bad losing streak. You're due for a win now. Well, that's the gambler's fallacy, right? Oh, I did. No. No, I haven't. Let's go back. Okay. So I took it long here. It went and it didn't get to my target because my target was like way up here, right? My target was way up here. So I bailed on that one. Did I take a loss on it? I don't recall. I took a small loss on it, relatively speaking, for that instrument, rather, for the sim trades like that. It's a relatively small loss. So I guess I took it off right there, and then I went for the short. Okay, so I got short about like right here, I think, and enjoyed this thing down here. Now I had my my order was originally right here. When it did this thing, I moved it up. So I did get one contract filled. Okay. So I took here and here, but it was only one contract. And then I added another contract somewhere around here. So I thought that it was going to go down, and it didn't. It went up, and quite aggressively so. And hit my stop out on the whole trade. That's what happened. Do you watch all? Yes, I do. So the first thing is, oh man, that was a good downtick, by the way. I have, this is ZB and this is ZF. So this is the 5 and this is the 30. And then these are spreads. Down is flat. So what I should expect to see is sell the 5, buy the 30. So that's the first thing. So this is probably why it kind of didn't work out as well for me, is because if we're moving up and flattening, then I'm going to lose more on the 30 and the 10. So the spread continues to work against me, right? Now these other instruments. So this one right here, this is Japanese yen. There's a high degree of correlation between the two of them. Can you see that? It's like this is kind of turned, this turned up. Japanese yen turned up, right? Okay, gold. Gold also these days tends to be pretty positively correlated with the treasuries. So they sold down. Same with the treasuries selling down. And now the rest of these are kind of more for me to try and figure out what is going on in the market, like where is the money coming from, to and from, and that might help me in particular situations for me to determine, you know, why my instrument is behaving the way that it is. So I've got oil, I've got Kappa, these two are the S&P 500, which I honestly don't watch very much anymore. And Bitcoin is up there because everybody just loves to talk about Bitcoin. And then I also have the market analyzer, which is, you know, these same instruments, but I can kind of see, okay, wheat is up the most today. That's curious. So it seems, and the treasury's down at the bottom, it seems that concerns about inflation are the flavor of the day. Yeah, it was a decent trade thesis. It just, yeah, it was I'm not going to say it was a good trade thesis, but it was a decent one. It was way more speculative than I'd prefer to have, but that's almost always the case, is they're never going to hand it to you on a silver platter, right? I just need to keep with it like small one little trades until I've kind of got my feet underneath of me again and have a market that's cooperating. Some of that could just be randomness, right? But I kind of suspect that in this current market, there's something about it that I don't understand. Right? There's information predicting orders that's being dominant that I am not seeing. I'm browsing Reddit here to see if there's anything else for us to look at before I get going here today. Oh, look at that. We were talking earlier about, like, okay, I want to see somebody that's been doing intraday trading for more than 5 years on futures and has been profitable in those 5 years. There's somebody asking, is there a trader who's been around for a long time? Yeah, we'll see what they think about is a long time. Oh, this guy says he's been scalping for 24 years. I own a successful tourism business, so I don't need to rely on my trading income. Okay. Oh, so he's talking about stocks. So nobody in that thread actually confirming that. There's one thing I've learned, it's that the market always goes your way once you've stopped out. That is not uncommon for sure. Like, there really is something to this, like, I'll get in a position and it goes the wrong way, right? I mean, the thing is, if I'm getting into a position, maybe there are other people that are getting into a position. And if it's the market maker is the only one in charge, then yeah, you're going to get screwed. It's like if we all played this game where we play rock, paper, scissors, and you're all playing rock, paper, scissors against me, but I can see what you're choosing before I make my choice every round, right? Then all I have to do is wait for you guys to all put your answers in, see which one most of you are doing. So if the most of you are doing rock, then I choose paper, right? And this is how you could get a situation where it's something that's completely random, supposedly, but most people are going to lose most of the time, right? Or we could do it heads, tails sort of a thing, right? That's kind of like the power that the market maker has. You can't beat him at that game. And if the market maker is the only one that's in charge, the problem is I'm not sure if that's what's actually going on here. I do see evidence for a large meta order long. I don't know if that one's going to continue or not. I'm thinking back on it and I'm like, going for like the breakout really probably didn't make sense. It has been more in a mean reversion period. They, like they're concerned about rates and everything, but they haven't been able to attack this, like really get it below 111, really get something going. It always seems to revert back up. And a lot of the trades that I've been taking lately have kind of been along those lines where I'm expecting it to continue through and it didn't. I think part of that is because it was like all momentum all the time for such a long time. It basically got to the point where it was like you just can't ever take anything against the trend, right? But that hasn't been the market the last week. Oh, this one's weird. So somebody posted a study on subreddit that says the idea that U.S. conservatives are uniquely likely to hold misperceptions is widespread, but has not been systemically tested. Research has focused on beliefs about narrow sets of claims never intended to capture the richness of the political information environment. Furthermore, factors contributing to this performance gap remain unclear. We generated a unique longitudinal data set combining social media engagement data and a 12-wave panel study of Americans' political knowledge about high-profile news over the 6 months. Results confirm that conservatives have lower sensitivity than liberals, so I don't know what they mean by lower sensitivity, but performing worse at distinguishing truths and falsehoods. This is partially explained by the fact that the most widely shared falsehoods tend to promote conservative positions, while corresponding truths typically favor liberals. Problem is exacerbated by liberals' tendency to experience bigger improvements in sensitivity than conservatives as the proportion of partisan news increases. So, I mean, I can believe that hypothesis, although I do kind of question, like, what were the questions you were asking and stuff like that. But then they end with this. These results underscore the importance of reducing the supply of right-leaning misinformation. That's like, okay, so they came up with a total bullshit conclusion. So now I'm hyper suspicious of this study. Hey, and then are they going to continue up and go for a new high? Once they get over, like, this next little spot right here, it gets a little bit more difficult. If people can lose systematically, why can't they win systematically? Yeah, the spread is a big part of it. So the first thing is like, so let's say that I were to come in here and just at random pick, will it go long or short? So I have some way of randomly picking a time and randomly picking a direction through which and I'm taking equal risk reward, right? So on that, I should, on the average, break even. So why don't most people break even? So if we draw that out like a distribution, you're going to see a distribution like this. This is a Gaussian distribution. This is our assumption that if it's a random trade, then the trading should be random, right? Well, you already pointed one problem out, which is the spread. So because we do not have the ability to get at the front of the queue, we are basically giving up the spread every time. If you could always catch the edge, or you could always be in a good catch where they don't, where you get filled on a limit order and they don't, no toxic order flow, then you could be the one making money on the edge. But generally speaking, as retail traders, we give that edge up. So that's going to account for a certain amount of difference. And so what we have to do is we have to move this distribution. So if this is the 0 line, right, then we're actually going to get something like this, right? To where most people lose. Now, the other issue, though, is that probably the majority of order flow is uninformed and has no real edge. So it's actually like all of this stuff right here, right, is actually just random. Whereas these guys are the people with the actual edge, right? So what that does is that kind of increases the kurtosis. It like kind of squeezes these in and this tail out. So what you actually get is something that's like very, very, with a really, really long right tail. Where it's like there's probably only a handful of them, but the handful of them that were successful have made a ton of money, right? And that's why anywhere from 75% to 95% of retail traders fail. So it's inherent in the game that most people will lose. So like even if everybody was informed, still should be the majority of people lose. But maybe it should be like 60%, not 95%, right? And why is it the only 5% of people end up winning? It's because the people that are winning have such a huge advantage over us, right? Like somebody's buying it. I have no clue why, but somebody out there might know. And if they kind of knew that ahead of time, then they might have been able to front run it and made money on it, right? It was thought that digital information and the rise of AI will create fat-tailed internet economy. It turned out Pareto won again. Well, it will. So my prediction for how will AI affect the economy is that I think that the overall standard of living, especially for the lowest, like 20% of people, will increase substantially. But the income distribution will probably become even more skewed. Which is to say, these guys that are like billionaires right now, they will become even more relatively rich. Like, it could be possible within our lifetimes to see billionaires be doing truly astounding things, like, you know, building their own giant space stations and that, you know, like science fiction kind of crazy stuff. They take all of those efficiencies and put them together with AI, you could truly get like astounding levels of wealth. It may also be the case. I also wouldn't rule out like what I would call like, oh, and this is gonna be like, this is gonna sound so weird, okay, but like radical deflation. You could see radical deflation in some industries. So like the best example that I keep bringing up is housing. If they get to the point where they can build houses with robots, or they're able to find kind of more consistent ways of, you know, like they're talking about 3D printing the house. Well, I don't think you want a house made out of concrete, but if you kind of have these kind of more, if you can industrialize the production of houses and automate the production of houses, you could see the cost of housing go way, way down. Right. So that would be really ugly for some people. You know, like there will be people that bought houses that will be underwater. But in the end, it will be better for everybody if houses are cheap. You can get in houses for cheap. But that means the price of the house will go down. That's deflation, right? So you might see rapid deflation, and thus, you know, some people may not be making a whole lot, like that their wages may stagnate or even go down, but their quality of life will still go up because everything becomes so cheap to them, right? I'm kind of starting to see a future where, and I don't think that this will be my lifetime, but maybe my lifetime. This is like a 30 to 50 year kind of thing that I'm thinking about. But that I do kind of think that it will turn into a thing where things will be so cheap that even if you don't have even with an average job, you won't have to work a whole lot. That it'll only be the people that are really motivated and really want to have super nice things that will work a lot, and everybody else will just live average lives and just kind of work what they have to. So it will skew that distribution. It will be even more of a Pareto, or whatever you would call it, right? Really, really long tail. Well, I got a little bit excited when we caught up to O2 half, but it's created another liquidity hole here, so. I think one of my problems is I really need to get back into the habit of, when I take a position, really focusing on doing it when it doesn't seem like there's things going on. I think that I'm chasing moves a little bit too much. That might be part of the change in my performance too. It could just be random. I don't know. All right, guys. Well, S&P 500 seems pretty tight here today. It is options expiration. I probably should have considered that a little bit more too. I'm going to put markets to crash up after options expiration. That's kind of the open question. So there are kind of some things that we're seeing in the flows that kind of suggest that there might be like a crash up next week, that like equities might like push dramatically higher. So see you guys next week. Yep. In the meantime,